The Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. Yeah, so anyway, we got a good show planned for tonight. We're going to talk about hedge funds here in a second. But something I have in the works, which is going to be epic. It's going to be unbelievable. I'm going to have a guest on who works at a gentleman's club, and he's a general manager. And we're going to talk about the economics of strip clubs, and it is going to be very illuminating. It's going to be, because it seems to me like an interesting business, and it is not like I have ever used the product. So I don't know when that's going to happen. Maybe in July. I got some traveling I got to do, but that is going to happen at some point, and it is going to be epic. So stay tuned. Listen to the Jared Dillian Show, and I will let you know when we will have our guest who works in the strip club industry. All right. So you might have heard of a hedge fund before, and you're like, what is a hedge fund? It sounds kind of sexy. Mutual fund doesn't sound very sexy, but a hedge fund sounds sexy. Now, can you invest in a hedge fund? Well, the answer is maybe. It's actually not as high of a barrier as you think. So you have to be what's called an accredited investor. And an accredited investor must have $200,000 in income and $1 million in liquid net worth in order to invest in a hedge fund. So it's a lot of money to a lot of people, but those rules were never indexed for inflation or anything. That's been in place for years. So now, over time, that has become accessible to a lot more people. Having said that, even if you're eligible to invest in a hedge fund, how do you find a hedge fund? How do you know a good one? And because there are some, I've never talked about this before, but there are rules around hedge funds. They really can't advertise. They are private investment partnerships, and they must have under 100 investors. And it's really just done by word of mouth. You know somebody. And I've invested in a hedge fund before, and it was because I was a friend of a friend. So it's kind of an exclusive club, and it's one of these things that rich people talk about at cocktail parties. They talk about their hedge funds. Well, I'm invested in Blue Rock Multi-Strategy Class A Fund, and I've made 23% this year. And someone's like, "Well, I'm invested in Round Hill Macro Arbitrage Fund, and I've made 31% this year." So the hedge fund industry has had a bit of a bumpy ride. It's starting to come back. If you go back 20 years ago, there were thousands of there's still thousands of hedge funds, but there were many, many thousands of hedge funds, and a lot of them were very small. I actually knew a guy in New York, not a sophisticated guy at all. Let me put it this way. I would not give him my money. He was a former cash equities trader at an investment bank, and he started a hedge fund with friends and family money, and he had $40 million that he was managing, and I don't think he lasted very long, but there were a lot of hedge funds like that. The hedge fund world has become a lot more institutionalized over time. Hedge funds have gotten bigger, and they need to be bigger in order to scale, okay? So probably the classic example is Bridgewater, run by a guy named Ray Dalio. Ray Dalio is probably more well-known for his book Principles and his book tour and his Twitter presence and stuff like that. But before he did all that stuff, he just used to be a hedge fund manager, and he managed the biggest hedge fund in the world. They had $140 billion in assets. And Dalio himself is worth, I haven't looked at it in a while, but I want to say 12 billion or 16 billion or something like that, which I think would make him the wealthiest financial industry person behind George Soros. And Soros, I think, is worth like 35 or 40 billion or something like that. Bridgewater, I don't want to get too deep into the weeds on Bridgewater. Bridgewater is a very interesting place to work. They have this culture of, I forget what they call it, like extreme transparency or extreme openness. So there's no such thing as white lies. There's no such thing as small talk. If I think that you suck, it is my job to tell you that you suck. So imagine working in a place where everybody is just very blunt and they tell people they suck all the time. And it takes a certain type of personality to thrive in an environment like Bridgewater. You kind of have to be a psychopath. I know some Bridgewater alumni. They're very glad to get out of there. But there's a bunch of other hedge funds, and they do all different kinds of things. And we're going to talk about that in some detail. I did, at one point, have ambitions of opening a hedge fund, but it wasn't strictly going to be a hedge fund. It was going to be something called a CTA, or commodity trading advisor. And a commodity trading advisor is basically a hedge fund that trades futures. And you have a lot of these in the commodity world. And I know some guys that do this. They trade agriculture futures. They trade corn and soybeans and wheat and options on all those. And they trade, there's meat hedge funds, CTAs, excuse me. There's meat CTAs. They trade live cattle and feeder cattle and lean hogs. It would be very strange to spend your entire waking hours trading hogs and nothing else, but people do it. So that's a CTA. So my bright idea at the time was that I would open a macro CTA. So I would be trading commodities, but mostly I would be trading financial futures. I would be trading stock index futures like S&P 500 futures and NASDAQ futures. And I would also trade interest rate futures and bond futures and currency futures and stuff like that. I was going to have a macro CTA. So this was about 4 years ago, and I did what I usually do in situations like this, which is I talked to as many people as possible. And they all said, dude, you have a great lifestyle. Don't screw it up. I'm like, what are you talking about? Say, you have a great lifestyle. You write the newsletter. You have no stress. It's a good business. Like, yes, you can make more money, but it is a massive amount of stress because there is nothing worse than losing money, because you're not just losing money for you, you're losing money for your clients. And your clients are being harmed, and you feel a great deal of remorse when you lose money. They said it's a massive amount of stress. Your life just disappears. So, if you listen to what happens in politics, I mean, if you listen to the Democrats and even the Republicans sometimes, and they talk about the hedge fund industry, they make it sound like it's a bunch of guys in Ferragamo ties that are throwing money at each other all day, and it's like a country club, but it's a very tough business, and it takes a lot of discipline, and it's very competitive, but it is very profitable. So how a hedge fund makes money is similar to how a mutual fund makes money. They had charge expenses. And in the old days, they would charge 2 and 20. And they would charge a 2% management fee and 20% of profits. And that's come down over time. I would say the average now is 1.5 and 15. So if you're managing $1 billion and you have a 1.5 and 15 commission structure, basically you will make $15 million in revenue off of the management fee. Now, performance is a different story. If you make 20% in a year, then you made $200 million, and you get to take 15% of that, which is $30 million. So 15 plus 30 is $45 million. And it's not uncommon for a hedge fund with, $1 billion in assets to have 10 to 20 employees. So 45 million split 20 ways is a pretty good living. Now, that's when times are good. When times are bad, it's a little bit more challenging because they have this concept known as the high water mark. Okay. So if your hedge fund goes up 20% and then it comes down 5% and then it goes up again, you don't make money until you get past the high water mark. So there's been instances where a hedge fund has lost a lot of money and they're way down past their high water mark. And they say this, we're basically going to be working for free for the next 3 years until we get back up there. So instead of doing that, they just close down the fund. Citadel, which is not even really a hedge fund anymore, nobody knows what it is, but it's really an electronic market maker and some other stuff, During the financial crisis, Citadel was down 60%. A lot of people thought that they would close the fund, and they didn't. And they actually made back the 60%, and they're much, much bigger before. So how do you like that? I don't know what Citadel has in terms of assets, but they do a bunch of different things. They have a securities arm and stuff like that, so it's a really big business. So let's talk about some of the strategies that hedge funds can pursue. One of them is macro, which is you're a top-down investor and you're betting that stocks are going to go up and down. You're going to bet that currencies go up and down, interest rates, commodities. You're not necessarily picking individual stocks, although you can do that. You're a top-down investor, and it's all based on macroeconomic trends. Okay. There's a bunch of other ones. There's convertible arbitrage. And basically what these people do is they buy convertible bonds, and convertible bonds have an embedded option. So they'll hedge it. They'll hedge the deltas of the option, and it's complicated. I don't even know why I brought that up. There's merger arbitrage or risk arbitrage, where a hedge fund bets on mergers and acquisitions between companies, which is a really, really interesting business. And I bought a book on it once, but I didn't take the time to read it. But, if company A buys company B and it takes 6 months for the deal to close, if you think it's going to close, you can buy company B and sell company A. That's going to converge over time. If you think the deal is going to fall apart, you can do the opposite. And there's sort of a percentage probability that the deal is going to close based on the prices of the stocks. But we're out of time on hedge funds. Anyway, we'll be back in a couple of minutes to talk about video games, which is something that people waste a lot of time doing. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.